Hey, everybody, welcome to the show. So, as entrepreneurs, we're really often concerned with growth and we focus on increasing revenue, adding more customers in order to scale as quickly as possible. But the reality is that businesses that win long term are not always the biggest. They're the ones that truly understand financial strategy. So, today we're talking about why revenue doesn't always equal profit, the financial metrics that most entrepreneurs are overlooking and why you should not, and how understanding your numbers can directly impact your ability to scale and access capital. And today's guest knows exactly what all of that looks like. Andrew Hunzicker is a former Big Four professional, entrepreneur, and founder of DOPE CFO, where he has helped businesses understand how niche specialization, stronger financial systems, and knowing your numbers can dramatically improve profitability and position companies for sustainable growth. Andrew, welcome to the show. Thank you so much for joining us today.
Thank you. It's great to be here.
So, former Big Four professional, that has to have been quite the journey, and all the way out to entrepreneur, and now DOPE CFO. So, catch us up. Tell us a little bit about what got you here.
Yeah, so it's a little bit of a long story. I'm 62 now, but the last 30 years, really 30 years ago, I got my CPA license in Oklahoma, and my journey was a little bit different than most because I got my CPA license when I was 29. And so most people get it right out of college, and I took a different track, did some entrepreneurial things actually. Side note, I opened up the first indoor rock climbing gym in the Midwest. And my banker shut me down in my mid-20s. That happened to be my father, and he told me indoor rock climbing would never take off in America. So I was very early to a really good idea, and we could have made a lot of money. But anyway, that's another story. But anyway, I went back, finished my accounting degree, and I knew at my age to get into the Big Four, I had to really score well on the CPA exam. I ended up winning the highest score in the state of Oklahoma on the CPA exam in 1995. And so that landed me a job 30 years ago, 96, at PwC in Dallas, which really was the top global accounting CFO firm in the world. But that education they gave me over several years was invaluable. Being an audit manager on clients as big as Nokia, but also small clients of all different industries. And then fast forward 2000 to 2010, literally almost that exact decade, January 1 of 2000 to the last day of 2010, I was CFO at my client, which was a series of oil and gas entities. And so many people do that in Big Four. They go into Big Four, they get to a certain point, and then they go in as CFO at their industry. My boss and I co-founded in that 10-year period. We co-founded a drilling company. It sounds not very romantic, but we needed $70 million. And so we went out and raised private equity, $40 million, and layered on debt. And we built 7 drilling rigs. Cost about back then, 2006, 10 million per rig. So they're very expensive. But anyway, we sold that company to Chesapeake Energy, a Fortune S&P 500 company, 2010, for almost 90 million. When that happened, that's how we get to DOPE CFO. I said, I'm out of here, Oklahoma. Goodbye oil and gas. I'm going to go to where I love to be, which is Bend, Oregon, where we ski and rock climb and float the river. And I've been here ever since. And it just so happened that the cannabis industry Oregon was the second state for it to open up in way back in 2012. And I kind of accidentally fell into that industry and started being a CFO in that industry. And that evolved over 5 years into what's now DOPE CFO, where I used to serve clients as a CFO. DOPE CFO, I now teach CPA. So I've taught over 2,000 CPAs in all 50 states, including national accounting firms, come to me to learn how to actually do cannabis CFO accounting and tax services correctly. And so now I teach the people that go out and serve the clients, the cannabis farms, the dispensaries, the hemp companies, the beverage companies, the manufacturers. And so that's where I am today and absolutely loving it. So now I've kind of gone from accountant to CFO to CEO and having customers, and it's just a ton of fun. I'm going to keep doing it as long as I can enjoy myself.
That is a fantastic journey. That is so exciting. And the rock climbing, wow. So how do you still think about that a lot? How you had started your indoor rock climbing and then now they're just literally
Oh yeah,
everywhere?
I rock climb 6, 7 days a week. We have one of the Smith Rocks, Oregon is 30 minutes from here. It's one of the most famous rock climbing destinations in the whole world. And so I met and climbed with people from all over the world. And I'm very, very active in the scene. And my son, who's 20, his best friend, just randomly, his father, same year I started a rock gym, 1991. He started a rock gym in Portland, Oregon, and he's still doing it. He has 12 gyms now. He has one of the biggest mansions in Bend, Oregon. They spend their summers in Europe. We laugh about it a lot. His education's not super high, but he stayed with the rock climbing industry and yeah, so it's fun to see. I love it. It's a huge global industry at this point. And I still partake in it every day. Of Most of my best friends are in the climbing community as well.
So that's a really great example of something. So you touched on, I mean, clearly it doesn't always take the most advanced education, although you do have one in this case, to take an idea and to really push it forward and grow it into something that is profound. And so I think we have a lot of entrepreneurs and business owners who are listening, and I think a lot of times they're thinking about reaching more people. But the example that you just gave is about like a highly specialized niche business that's out there. So do you think that those types of businesses ever outperform, broader businesses?
Oh yeah, it's definitely good to have especially that said, if you're very, very early in a new thing, like I don't know, if you just have the latest crypto company or whatever you have, if you're very, very new, it can be tough. And you look at some huge examples of this. Facebook, what was the one before? MySpace went under, Netscape, things like, but Facebook didn't make money for years. Neither did Spotify or Reddit or Uber, companies that lose money for years and years. And so if you're very, very early to a very, very big idea, you're going to need a lot of capital or you're not going to survive. And that was the name of the game. And with a rock climbing gym, obviously it takes real estate and facilities and capital. And I was in, my early 20s and my dad helped me a little bit, but he was not going to sink millions of dollars into a crazy idea. So now if you have a more normal business, I don't know, you're opening up a plumbing business or whatever kind of business you have, that's a little bit more, or say a restaurant or something simpler. We've got more metrics. We know you can really do your homework and research and know if you're going to be able to make it. And then also knowing your industry. So again, restaurants is a good one because like where I live, we have hundreds of restaurants in this. We're a tourist town, and but they come and go. Some have been here the whole time I've been here, 20, 30 years, but others might be a really hot spot for 5 years and then go under. And part of that goes back to what we'll talk about as well with financials, numbers, profits, etc., and really being a great business owner. And so restaurants is a great example of you got to really know your stuff if you're going to succeed in the restaurant business because we're all fickle. Like might be the hot new idea last year, but no one goes to eat there this year. How do you keep that sustainable? And you might have really tight margins. For example, during COVID, a lot of restaurants went under because it was very, very tough on them.
So, and I think that's a great example that you just gave. So you're in a huge tourist area, and yet, and always people are seeking food, water, and shelter. But here we are with examples in the restaurant industry where you have restaurants coming in and coming out. And so they've probably had revenue flowing at some point. And now you're saying revenue doesn't really always equal profitability, which I think is a very important concept as a business owner, you have to understand. So tell us more about that because I feel like you're going to touch on margins, cash flow, expenses, just all of those things.
Yeah, so the accounting code and the tax code are insanely complex. Both of them. GAAP accounting, that's true financial statements. You get audited, and then IRS tax code, they're so complex, they're almost meaningless. So we're always going to also be a good CFO and accountant really looking at cash flow because that's number one. Same investors do the same thing. They want to know what the free cash flow is of a business. And so you can, depending on which lens you're looking at it, you might look at a company from taxable income. And so if I'm an owner, same for my business. I want my taxable income to be as low as possible. Same for you. And you file your tax return at the end of the year. When you look at your all the revenue, your wages, and whatever else is on your income side, you want that number to be low because you know you're going to pay a lot of tax. And so same with businesses. We want to minimize our taxable income, but at the same point, we're trying to build a successful business that's sustainable. Our valuation goes up. Maybe we want to do an exit. So we got to be profitable as well. Now, unfortunately, there's so much politics into our tax code. So oil and gas is a good example. Oil and gas has historically gotten insanely good tax breaks. And so on paper, it can look like an oil and gas company is making no money, but their cash flow is extremely good. They get very big depreciation write-offs, which is a non-cash expense, lowers their taxable income. And so when investors look at a company, might look like their book net income is zero, but then they're going to add back in depreciation to look what their actual cash flow is. But if you're a small business owner, less than 1 million in sales, you really got to be on top of your cash flow weekly. And I'm the same way. I manage my cash flow every week. I know exactly what's coming, what big things are coming out in the next 6 months, like the insurance payment or taxes or whatever, but also what are the day to day? Am I buying inventory? We really going to manage that cash flow number because that's what can really leave you in a bind. If you can't forecast your cash 8 months out or 12 months out, and all of a sudden you get to 8 months out and you look in the bank and you're negative 100 grand, it's, oh crap. How do I get money? You call your aunt or you try to go to the bank. You can't quickly go to a lender or an equity provider. It takes a little bit of time. So you need to plan ahead. And so you always got to be thinking about what's your access to capital. Do you have a backup line of credit? Maybe for some business owners, that's their house. In a worst case scenario, they can start tapping into their home, but you've got to be thinking, where's my cash flow going to be tight? Of course, I want good books and records and accounting numbers, but we're going to manage all three: taxable income, GAAP income, and cash flow, to know what we're doing. Now, to do that, I, I've and I'll talk about this more at the end, but I think all business owners want, from again Bill Gates, who owns Microsoft, down to Sally, who owns the corner restaurant food cart. We all mostly want the same 4 or 5 things, and I'm going to contend that those 4 or 5 things that we all want as business owners are absolutely reliant on world-class, rock-solid, audit-ready accounting books and records. And you don't get that without a great CFO on your team. And so that's frankly one place most small people, small owners, and I get it. If you're under 1 million in sales, it's hard to bring on a CFO. But it's kind of one of those chicken and eggs. Without a great CFO, it's going to be really hard to build your business, including access to capital. The number one thing investors look for before they write a check is there a world-class CFO on the team? There was a survey last year, I think, on CFO magazine on that. So sometimes owners tell me, "Hey, Andrew, I don't need you yet. I'm just raising capital." And I'm like, "Oh, really? Yeah, you need step one's get a great CFO, and then we'll go raise capital."
So
But
for
that's
everybody, you just touched on something really important. So let's assume for a minute that a big portion of our listener base is below 1 million in revenue. And yet we know that as part of that financial strategy, they need to be focusing on all of these metrics. So tell me a little bit, or tell us a little bit about how you could see maybe a fractional CFO coming in to assist, to help kind of get them started thinking about the right things. What does it look like when a business like that brings somebody in fractionally?
So it just depends. Again, if you're less than 1 million in revenues, you can probably get an okay fractional. There's different levels of fractional CFO. If you want a world-class CFO, it's going to cost a lot of money. You're not going to get a good quality solution. So say you're bringing in what, 80 grand a month in revenues. So maybe you can pay 3 or 4 grand a month to a fractional CFO. That means they're only going to have a handful of hours. They're not going to, a deep dive CFO at any company is the number two at the company. They're going to be helping you build that company from startup to exit. Someone who has 4 or 5 hours a month is not a number two. There's someone who's dipping their toes in once a month. Now, that said, they can still add value. They can make sure the accounting's good. They can make sure your internal controls and accounting policies are good so that you're not losing or bleeding money like many companies are, that you don't have any risks that aren't mitigated that you may not be thinking about. Obvious ones are just like insurance. Are you properly insured? Or do you have correct controls? Do you have governance in place? Are there employees stealing things from you? Do you have processes in place to prevent that and any other risks? So when you're small, you got to be super lean, and then knowing those metrics. So again, if say you're a restaurant and you sell chicken and there's everything from Chick-fil-A all the way up to the fine dining chicken restaurant, which part of that market are you in, and do you know the benchmarks in your industry? Like, oh, the chicken restaurant I have, labor's the number one cost outside of rent and facilities. It should be 22%. And if it's 26%, I might be going under. And so you can make sure, like, you not only want to meet those benchmarks, hopefully you want to beat those benchmarks, because that's how you can, if you're on a razor thin margin, and again, $1 million business is about 80 grand a month in revenues. And if you're buying inventory, paying for rent, labor, insurance, taxes, you got probably very thin margins. And oh, by the way, yeah, CFO or whatever as well. So in those kind of situations, say you're making 1 million a year and your net income's 10%, not your gross margins, your net margins, what goes home to you. If you net 100 grand, the end of the year, that means you're paying yourself for 100 grand job basically, and you're paying tax on that. But if you really manage both sides, we're always thinking, and I know business owners are good about thinking about revenues and growth. That's one way, but also managing expenses. If we can grow revenues faster than our expenses grow, we can take home more at the bottom line. But it is rugged when you're at that below 1 million and you really want to get to the 1 million to 5 million, to where you can start really building something of value. And by the way, yeah, selling a business that's doing under 1 million a year is going to be very hard. You're going to get very low multiples as well.
So, some of the other deeper metrics in there. So, you've talked about things, you haven't said this specifically, but some of what you're talking about is also your burn rate. So, how quickly you're
Yeah.
going through the cash that you have, cash conversion cycles. So, in addition to those two things, are you also tracking things like net revenue retention?
Oh, yes. We're going to look at every piece of the puzzle. So again, a world-class CFO is diving in deep to every little thing, starting at the top line revenue and working our way down. There's no line we're not looking at. So if I'm looking at rent expense, are we paying a fair rent? Are we actually in the best location? Are we going there? Are we looking at revenues? What is our customer mix? Depending what kind of business. So if I'm an attorney or an accountant, yeah, what am I retaining in these customers? Are they repeat customers? Same for plumbers or electricians. Same for a restaurant. How do you actually track customer retention? How do you reward them? And you start thinking, how do you get more people back? I have favorite restaurants in this town, but I find it hard to get there because there's so many choices. We want to go back, but if sometimes they'll send me a special offer to get that customer retention back. Some businesses are heavily dependent on 2 or 3 customers. That's a huge risk. So that would be an audit risk. Maybe you're a defense contractor and the government's your one big customer and they fire you, you could be out of business tomorrow. So each business is going to have different metrics. So one little small sub niche of the cannabis industry is the retailers, and any retail business, clothing, you probably buy clothes like my wife into the clothes shops and shoes. And what is your inventory mix? What's your high product? What's your low product? Where are you putting it in your store? How much are you moving it around? There's like my former childhood best friend from first grade. He was the president actually of Neiman Marcus for several years. And he went got a Harvard MBA, super smart retail expert. And we spent a fair amount of time walking through some stores. And it's mind-boggling how complicated you can simply look at your inventory strategy of what you're buying, what you're selling, where it is on the shelf, where it is in the store, how you're mixing it up. So yeah, we're going to look at a CFO adds value. We're not just printing out a P&L and a bookkeeper. So we want to look at how we can build revenues without or grow revenues and then profits at the same time by minimizing those expenses. But we'll look at 100 things. If it can add value, we're looking at it.
So now you're into strategy versus tactics. So interesting story. And I'll make this very quick, but I went out to breakfast this weekend with a friend. And when we got time to pay, we're on two separate checks. She pulls out a coupon and she had $10 off on a mailer that they had sent her. So that's the customer retention strategy. Now, my eyebrow immediately went up in the air because both of us are rewards members for this particular restaurant that we were at, and I won't say which, but I didn't get a coupon. And so I was sitting there thinking to myself, she gets them all the time. I never do. And so I asked about it. Their strategy was only to mail those to people within a certain radius of the restaurant. And here I'm thinking, so I am 3 miles outside that radius, but I'm one of your rewards members. I would come back even more often if I got a coupon. So there's a really good example of how I think whoever's looking at their financial strategy maybe left that right on the table, is leaving money on the table with something as simple as a mailer.
Yeah, I totally agree. And it's the whole, when you start getting into marketing and sales, it is so tricky because and you all probably do this and I do it. So organic versus paid. So if you're anywhere in the influencer space or whatever, maybe you've got your YouTube channel like I do. And our podcast, we try to put out a lot of free content to grow our audience. And then we also have paid ads and we have newsletters and we have just all kinds of things, flyers and mailers. And sometimes it's tricky to figure out when a customer does come, where did they come from? Like, what do I want to increase? And I get a customer and they say they saw everything. They saw our ads and our newsletter and our podcast. And so it's sometimes very, very tricky and complex, but you can, the better you can track things like that mailer is a great example. That's something you can test. Let's send it out. We just send it to a radius. Let's just try sending it out to the whole city, or I don't know, whatever, a bigger radius, or to the people, maybe they do a different search in their database. Who's come here, 5 times in the last month? Let's give them a special reward or whatever. There's lots of ways that you can play around with that. And in today's world, and this is more for low ticket items, people are very conscientious about inflation and spending, and we all want coupons and discounts. To go out and spend money. You mentioned burn rate as well. That is a great question so that applies typically to like high tech startups, same in my industry, where a company is expected to actually burn through cash for maybe years and years. And so that's why they call it burn. You are literally taking cash and putting it in the shredder. And so hopefully if you're a small business owner, you don't have a cash burn. You're cash flow positive. If you're negative, say you have a business. I had a client actually that was in pharma, and they were making pills and different medicines for big pharma. They were a startup, and we helped them grow their company. They did an exit for 24 million to a global pharma company, but they were a startup, but they lost money every single year, but they knew it and they had a good capital source. They knew the name of the game was to grow their product all the way to exit. It wasn't about making net income. So you got to really know your market. But if you're a normal standard small business, you either need to be cash flow positive or you need to know where your source of capital is coming from. Typically lenders aren't going to give you a ton other than signing your whole life off. And so it's like, is that really a loan? if they want my house as collateral, I can just do that myself, get a bigger mortgage and be my own banker. Um, so it's tough, and the equity's tough too. If you don't have a really sexy high growth idea, good luck having anyone give you equity without it being very expensive. So that million below getting up to 5 million is really key. And so you got to really manage your business and know your cash flow inside and out.
So, for a small to a medium sized business, because now we're saying your financial strategy definitely impacts your ability to access capital. And as part of that financial strategy, we're doing really good, solid reporting. We're working with somebody that understands how to get the data out of our various systems, because sometimes just even pulling the data out is a huge challenge. You've got it, but it's not in any type of organized fashion. If you had to give some advice to everybody in terms of, they're listening and they're like, wow, I am nowhere near ready, but I need to be. What would be like the top five metrics? If they could focus on five things, what would it be that they should be paying attention to, those top five metrics?
Well, it's hard to say if this is one or two or three, really. Revenue, gross margin, and net income margin are huge. So obviously, for any business, your revenues, if you're not growing sales, whatever you're selling, furniture or accounting services, um, that can be just huge. And so you're going to have struggle getting to exit. You're going to have trouble getting capital if your revenues aren't growing. So hopefully, whatever you're selling, usually the founders are very, very focused on revenues. So we don't have to talk about that too much. Other than when I project forward, sometimes they're a little more optimistic, like, oh, we made 80 grand a month for the last 5 months, but the next 5 months we're going to bring in 100 grand. And sometimes I have to push back. Oh, really? How, how are you going to do that and increase that? Gross margins are very big as well, whether you sell a service or inventory of any kind. That can be, if you're in some kind of retail business, typically your gross margin is going to be about 50%, maybe even less. And so that makes it very rough. If you have a retail business, you buy your product, you sell 100,000, but it costs you 50 grand just to buy the inventory. That means you only have 50 grand left to pay for your rent, labor, all that stuff. And so that's very key. Then labor, that metric is almost always a biggie that we've got to look at as well. I definitely want to look at benchmarking of other businesses as well, and then just make sure that there's no money bleeding out and due to some kind of risk or whatever, that you're paying the correct amount of things for insurance and governance. But would be the key. But then every industry is going to have their own little tweaks. And so, like if you're a cannabis farm and you're selling 83 strains that you grow, which ones are the best? How long does it take to grow? What's the yield per strain? That plant gives me 1 pound. This one gives me half a pound. And so we really dive in to really the minutia of what your own industry is. And so you need to know those metrics left and right as well. Now my great great granddad started a business in 1909, so over 100 years ago. There are very few businesses that are still around after 100 years, but this one still is. It's called Hunzicker Brothers Electric. It's an electrical distributor in Oklahoma with about 100 employees. But and I actually worked there for a period of years and was on their board for a while. And electrical distribution's a very, very mature old industry, and they put out just amazing key reports for that industry. And so whenever we reviewed at board meetings the P&L, every single line item, it'd be like whatever it was, insurance, rent, labor, inventory. We would know exactly what the average was nationally, what the average was in the Midwest where we were, whether we were outperforming, underperforming, and wherever we were underperforming, we would try to improve that. So we always want to, for any company, you want to be best in class. So if you're a plumber, you want to be the most profitable plumber in your region. And so that's where that benchmarking really comes into play, because you can usually find that data somewhere, what your competitors are doing. And so if you can find that, that's very, very important as well. Same if you're an influencer. Find out what the normal rates are. And I've seen people all over the place on that industry.
So, we've talked about financial strategy, and that including working with a professional. if you can, full time and having a CFO. If you can't, starting with someone fractional, bringing somebody in that really understands what they're looking at. We've talked about reporting and how vital that is. And now you're even into benchmarking and you're talking about locally, regionally, and understanding where you stand in position to just the market itself. Those are all really sound decisions, right? That any business owner could make to kind of help themselves grow and scale. But are there any other decisions that you would ask a business to consider that would separate them from a business that might get itself into trouble were it not to make this decision? Is there anything else?
Well, the I always go back. So we've dealt with just thousands of small, against businesses at the $1 million level up to 5 million, even 8 or 10 million. Invariably, like 9 times out of 10 or more, the books aren't only incorrect, they're horrific. They're it's in our industry, it's called cleanup, and that's all anyone talks about. Oh yeah, I got this new client in XYZ industry or whatever, absolute disaster. And so again, to set yourself up, and why those metrics, if you are tracking those metrics, and especially in line of your competition, and you can show that, yeah, our industry makes gross margins of 62%, but we're making 68%. It's going to help everything about your life. Raising capital easier, selling the company easier. It brings more money in your pocket day to day. And so knowing that first, now going back to what I said at the first of the show, you can't even, I tell business owners, I come in and they want me to fix yesterday what their problems are. And here's another problem. Software now is pretty amazing. It's very good looking, whether it's QBO or other accounting packages. And so you can get a system that prints a beautiful report and with graphs and all kinds of things. But if your underlying data is actually incorrect, those reports are meaningless. So we don't even talk about reporting until we first make sure we've cleaned up, that the accounting's correct. Bank recs are done every month. Every single balance sheet account is tied out. We know whether it's inventory, fixed assets, inventory, we do things like counts, tie it back to the system. I find lots of people that have a lot of inventory never bother to count it. And when I come in, I was like, great, you're getting your inventory stolen from. I'll go show them. They'll show me a pretty report where they've got 8 boxes of this tea, and then we go count it, and it's only 3 boxes. And so we will really go through the entire balance sheet, the cash, the AR, the AP, the debt, the fixed assets, inventory, make sure those numbers are actually correct. Same on the P&L. Are your revenues really what they say? Someone says, oh, Andrew, my revenues are a ton. Why am I not making any money every month? Well, okay, let's make sure your revenue numbers are correctly input. Same with your expense numbers. Once we're confident in the numbers, then we can do reporting, then we can do investigation. And so when we report for clients at month end, we give them the basic 3 financials: P&L, balance sheet, statement of cash flows. Then we give them a forward-looking, because those are all backwards, forward-looking rolling cash forecast 12 months. We'll do the budget versus actual. We'll do dashboards tied to their industry. Then we'll do benchmarking. And then we'll do deep dive analysis into where we think we can add value. We'll highlight areas that, oh, this popped up. And so if you really do it correctly, you can start to get that accounting set up. That will lead to better internal controls. We'll build out an accounting policy procedure manual, which is needed for audit. We'll get that layer down. That leads us to world-class reporting. Once you have that reporting, you can get the 2 things most owners want: more money in your pocket and lower taxes. And we get those 2 things, and then you have peace of mind that your risks are protected and you're maximizing the value of your business. And then you can focus on the fun stuff, which is actually growing your business on the marketing and sales side. So that's the way we do it. Not everyone does it, but usually there's a cleanup. So I guess to answer your question, I know 90% of your listeners, I could just guarantee if I came into your business, I'm going to find there is no accounting policy procedure manual. There are no internal controls. Your books are probably incorrect. That means your tax return's probably incorrect. You're probably leaving money laying on the floor, both on sales side and expense side. And so it's usually what these owners are not thinking about. They're so focused on their product, their revenues, their marketing and sales, that they think all that stuff is just a cost, but it's really not. So again, that's why, and you go to the top. Microsoft, IBM, NVIDIA, Amazon, the CFO is the number two at these companies. Why? Because they get it. The big people get it. You need that talent on your team to really make sure you can grow your business. And a good CFO will be that number two at your company. It won't just be a bookkeeper.
So for the audience who's sitting there thinking, oh my gosh, I've got some work to do here. And I'm even thinking back on some of the businesses that I've been connected to and thinking, wow, there was probably a lot that should have been going on that looking backwards now it wasn't. I think it's always easy sometimes, hindsight's 2020. But what is like three things they could do right out of the gate by tomorrow that would get them started on a journey to at least taking a deep breath and feeling like, okay, I'm moving, I'm heading in the right direction. If my goal is ultimately that I want a very strong business structure, I have revenue, I'm showing profitability, I'm fundable, I can get access to capital, my books are clean, so my reporting is good. How can they just take that? I mean, every journey starts with a single step. So what is that number one
Yeah.
step
So
take?
first, to really look at your business. And so I've worked with a lot of startup founders, and they used to always tell me, I've got a world-class product, my whatever, my thing, my new software is the best ever. And I'd always say, it's great you have a world-class product, but what you need is a world-class company. And so really do stop and do a deep dive into the back office of your company. Because we definitely want to get back to the front office, the revenues, the growth, the marketing and sales, but let's first get to that foundation level. Who are the people? Are we staffed correctly? What do our books look like? So first and foremost, do you what does your accounting back office look like? Do you have this person that does your tax return once a year? That's not a CFO. That's a person that has 800 clients, and they're going to send you an organizer to get your information so they can spit out a tax return. And by the way, they're not going to care if the info is right or wrong. They're just going to plug the numbers in and tell you what you owe. Or do you have a bookkeeper? Again, bookkeepers are notorious for having dozens or hundreds of clients. They may not have an accounting degree. They may just have been taught by QBO online or YouTube. So first question is, if you don't have a CFO, who's that person doing the accounting? I found people, one client I came into 10 million capital raise, and I came in, I became the CFO, but I said, who's doing your accounting? Oh, Kerry, he mows our yard and then he does the accounting on the weekends. I was like, great, your lawnmowers. And he was like 22. I was like, that's probably not a good idea. You just got investors to give you $10 million. So who's doing it? If it's not someone that's got a decent resume, look someone out. You can reach us and contact us, and I'll put you in touch with somebody. But if you can get somebody good on the at least a degreed accountant. I'd prefer a CPA, someone who's got a decent resume that can come in and do an assessment and look at your books, your books and records, but also your internal controls and governance, because that'll highlight a lot of issues as well. And then from there, make a recommendation to get that cleaned up so then you can start focusing on the reporting and strategic. And then because that's again, if you say you do have an exit lined up or an M&A and they come in, I've seen many deals killed in due diligence. They see the outside of the company looks real pretty and the revenues look good, but then they come in and they realize the books are a wreck and there's hidden liabilities, and they just either walk away or they lower the price. I say it's just like selling your house. It looks pretty on the outside, but they come in and the foundation's cracked and the house is going to fall over in 3 years. The buyer's going to walk away or offer you 300 grand less or whatever it is. So it's the same with that. So that's where I would start, is looking at that piece of the puzzle, and you'll work your way back up towards the revenue and product side.
What you just described in terms of the mess reminds me of something I heard about that being compared to being a Monet. So from far away, it looks great, and up close, it's a big old mess. And so anytime I ever hear anything described like that, I think it's a Monet. So everybody listening, we don't want you to be a Monet. We want you to have good systems in place so you're not a Monet.
And
Um,
I will say it is tough being a entrepreneur, and part of it is persistence and not giving up. And
Yeah.
even going back to my rock gym days, maybe I could have been more creative and figured out a way to keep our gym running. We were open for almost 3 years and hung out to when the boom happened. So you got to be persistent. You got to not give up. If you're a business owner, you're working 7 days a week probably. Um, but yeah, hats off to you. That's what our country is founded on. It is amazing to be a business owner, and you've really got to manage that whole entire business, and it is hard because you're dealing with so many things from revenues all the way down the balance sheet.
Well, it sounds to me though, Andrew, like that experience helped shaped the journey that you had to get here. So, and it sounds like you're doing a lot to help other businesses. So, tell everybody how they can connect to you, follow you, get more information, maybe even get a referral from you, like you mentioned.
Yeah, so we're very easy to find. So dopecfo.com or dopecfo.us. My email is very easy, Andrew at dopecfo.com. We have tons of free information we put out. You can follow us on Facebook, on Instagram, on LinkedIn. You can find me most of those places. And then, yeah, we can either give you ideas or connect you with somebody that can help you get better. And the people I teach in my network, I teach them to not be most of the industry. That's another problem we haven't really hit. If you're small and trying to go get help, in the old days when I was at the Big Four and even national accounting firms like RSM and Grant Thornton and Witham and Cohn Resnick, these big firms, in the old days, they delivered a world-class product with great service. In today's world, they don't have great service. They're too understaffed. There's a major staffing issue. They're all shipping accounting work overseas to India and Asia. They're also using AI. And they're very pricey. So you're not going to be able to use any kind of firm if you're small. Take them off. Same with tax professionals. Hundreds of clients, they can't really help you. They're too busy. Same with bookkeepers. So you need a CFO that's specialized in your industry and only has 3 to 5 clients. The problem is very few people do that. We do have people that do that in more than one industry. So if you do want someone like that that will go deep with your company, that's what I recommend. But it's hard to find because again, most of the industry is doing a different model where they're serving hundreds or thousands of clients. And when you do that, you can't give anyone great help.
Oh, thank you so much, Andrew, for coming on the show today. We really appreciate it. You've given us so much to think about and some really great steps, things we can do immediately before tomorrow. Everybody listening, if you are sitting here and you're thinking to yourself, I've got some work to do on my business. I don't want to be a Monet, but I need some help getting started. Get out there, get connected to Andrew, and let him come in and take a look at what you've got and help you get started. All right, everybody. Thanks again for joining us, and until next time.